Hey, it's Rick here. It's Sunday morning, getting ready to do my weekend scanning, but I thought I would throw out a quick video reviewing last week, particularly Friday was an interesting day, and then sort of look ahead for this week. Our the risk model has been bouncing all over the place, as has been the market for this week, but turned a lot more positive on Friday. So we'll see if there's some follow through this week. Particularly in the S&P 500, the Qs are still very, very weak. Looking at the S&P, you can see from here this sort of a chop fest that we've been in. A big up day Friday, up S&P was up 2%. This actually shows up better when I look at that. When I drew these boxes a couple of days ago and reviewed them with you, we came out of this area here a few weeks ago and then set a new range for the last since what is that, the 16th of November, I guess, 16th of December. And so we were, a couple of days ago, we are going to be either going this way or going up this way. Well, Friday they decided to go up this way. But it's poked its nose through this base, and as expected, it's going to hit this overhead resistance. So we're not out of the woods yet as far as any sort of a trend. In a good world, we'll base around here for a little bit and then start chewing our way through all of this supply up here. And then we'll see by the time we get up around here at 4,000, that's going to be coincidental to the declining 200. So that's going to be an interesting time. So that may happen this week, or it may take a couple of weeks, but there's, if we keep going in this direction, these are going to intersect here in sometime very soon, and then we'll be able to get an indication of where we go from there. So this is the S&P 500, which is representative of the 500 biggest stocks on the New York Stock Exchange. But if we look at the chart of the what's the New York Stock Exchange Composite Index, which is all roughly 3,000 stocks on it, you can see a bit of a different picture. It's now above its 200-day moving average. In this chop, we got above it, we went below it, now we're above it. So this is totally to be expected. But this indicates that the broader market is a little bit stronger. So under the hood a little bit, we could be seeing some signs of strength. You look at charts of the big boys like Apple, is dragging this thing down. Tesla, of course. Oops, I learned how to type. I can't type in the dark. Where are we? So these stocks are really dragging the S&P 500 down, and of course the Nasdaq. So, but the underlying is seems to be a little better. So, back over here and look at the Nasdaq. Nasdaq still has got a long ways to go to get back up to the 200. And again, you look at the broader, the Nasdaq Composite, which is like 3,000 stocks, it pretty much mirrors. So the whole Nasdaq tech sectors are still not very strong, but had a very strong day on Friday, up 2.5%. So maybe we're going to come out of this mess at the bottom and start heading back up. Going back to the S&P, the mid caps has a similar pattern to the composite. So there's some strength in the mid caps, which is encouraging. And then the small caps still below the 200, but showing a little bit more strength, but there's still a lot of overhead resistance up here. Dow Jones continues to be, I wouldn't say the strongest, but still fairly strong. Clearly above the 200-day moving average. Popped above this base here, but now we got into this digestion area here. So again, we're in a wait and see mode. The volatility index, which I highlighted a couple of days ago, I'm going to go to a weekly chart. I actually was studying this a bit more, and it's a pretty good leading indicator when you're in a trending market. Right now we're in a chop zone, so it's not that relevant. But if you take these spikes, let's move this out of the way. You take these spikes when the VIX gets higher than normal. This is a weekly chart going back to 20, yeah, it's going back 7 years. When you get these spikes, then the market tends to go down. For maybe not immediately, but it is a precursor to market activities. So here the spike was right near the bottom, so didn't last very long. Anyway, I'm going to keep I don't know what exactly to make of this right now. It's not telling me anything. It's just in this zone here. It did on the daily chart, did come down quite a bit on Friday, like 5%. So getting a little complacent. Volatility is drying up a bit. I think the market indicators I reviewed. Again, this I like to see. This is the NASDAQ. This red line is the number of new lows, and it's coming down, and it's coming down fairly sharply. The new highs have not started to tick up yet, but I think this is just a matter of time here. So I'm hopeful that this is signaling a potential turn in the NASDAQ. When you look at the up volume versus down volume, again, the up volume has now ticked up and crossed over the declining down volume. So this is a good sign in my view. So that's MarketSmith. Get this out of the way. Looking at where are we here? My positions. Heck of a week. You can see a lot of green on the screen. The market averages were all up around 2%, and I had 2 to 3% gains in virtually all of my open positions. So yeah, it's been a really good week. And if we just do this every week, it would be just peachy. CPRX broke out very nicely, ran up. It did pull back, which is an indication that and the institutions aren't totally committed to this. They did let it settle back down. I took some profit on this one. I took a quarter of my position off when it got to this previous all-time high here, and then it rocketed through that, and then just it got fairly extended during the day. It was up almost 10%. So I took another 25% of the remainder off, and I'm content to sit with this one now for a while and ride the moving averages. So my stops are going to be below these 10-day, 8-day, and 21-day moving averages. Dollarama. This is a new one I bought yesterday. I don't know if I talked about it. It's coming out of this. Let's just go here to a weekly. See, it's got a nice spacing here for several weeks since last July. Not really going down a lot with the market. And these pullbacks have been getting shallower. So nice little gain there so far anyway. Not done. GILD had a nice move. You look at the weekly here. The only reason I'm in this one, quite honestly, is Minervini had a call on it. So I just took a tiny position. I don't see the upside of this one the same way as some others. So, but I can't argue with this guy. So I took a tiny position. We'll see what happens. HIBB, again, this pattern is from a cup. This is what I would call a cup is forming in a cup and handle formation. So this is what you would expect. It's going to come up to here, and then in a perfect world, pulls back a bit, and then forms this, and then goes there on a weekly chart. So that's kind of a classic pattern. Not sure why this hit my radar. I guess I'm not even sure, to be honest with you. I guess this is standard, when it's basing near the highs, and these pullbacks get a little shallower, but this is not the greatest of patterns. But I managed to get into this one with like a 1% risk, and already it's up. Where is it? My remaining positions, it's up 6.5%. So I can't argue with it. It's worked out, but I don't think it was a particularly good plan. This one, however, I look at the weekly of this one, HWM. It's been basing now for better part of 2 years, and is now starting to break out of this base. So to me, this has the hallmark of a potentially really good move to the upside. And then when you drill down to the daily, again, these pullbacks are getting shallower and shallower and shallower. And so I entered on this pullback here as it broke out. I added actually up here 39, and I have a fairly decent sized position here, but I just may add some more to this one. The fundamentals are really good too. So having said that, I did take 25% of my position off the table on Friday into strength. I'm just chicken shit, really. I'd like to give money back if I've earned it. So anyway, still got 3/4 of it continues to rip, and if it pulls back and sets up another pattern, I'll certainly add that back. Logi is not one that, if you look at a weekly, you'd say, Rick, what the hell are you doing? Weekly downtrend, although it has crossed over the 40-week, and over here it's crossed over the 200-day, but the 200-day is still in a decline. I was just attracted to this because it made a nice run up here, full pullback. This was a shallower pullback. This one was a little deep. This was a little disconcerting. And then it broke out of this base. So I bought it here, added to it here, and it's working out. But I've got a really tight leash on this because, again, I don't have really good expectations. But at least I have a solid plan for this one. Saputo, the cheese, Canadian cheese. I don't know why I bought this. It's probably more out of boredom. That the Canadian dollar account has had no action in it for months now. So weekly looks okay. Again, after a nice move up, orderly pullback. Next pullback's a little shallower. Next pullback is shallower again. So relatively tight entry here. Stops under here. So far it's working out. It's up maybe a couple of percent. Titan. Good pattern here again. Fairly long base. This pullback here is a little deep, but it's shown some strength out of here. And then this big up move, which was this day here on earnings, had a fairly orderly pullback, a little deeper than I liked. I think I explained that before. So again, this one's got a tight leash, but if it goes, I really could have added to this one above here, and I still may. If this sets up, if this gets a little tighter in here, I may be adding to this position because right now it's pretty small. And then Yuri, another great weekly pattern, breaking out, coming up to its all-time high. this one on a daily, it's just classic. Nice move up, 30% move up, pullback is less than 10, and then gentle, back up again, comes back, retests, holds. This gets a little shallower, breaks out to a new high, but institutions don't support it. And this is what's been happening like for all year, for 18 months now. You get these breakouts, and then they fail. And it pulled back. Here it had what I call a reversal recovery, came down, but the close really strong. So obviously it's got good institutional support. And so I entered that the next day, and it's behaving quite well. I haven't sold anything. I'm taking a long-term view on this one. So I guess one of the takeaways from here is to have a plan. Every trade you make, some plans are better than others, but at least have a plan so you know what to do in all circumstances. A couple that are worthy of noting that I missed is I had a plan for these. Here, like last weekend, I said you could put a cheat entry over 52, but the risk reward was not great. That was my notes to myself. So 52 would have been right here. So it actually triggered on, what day would that be? That would have been Monday. It triggered, ran up, and then just fell right back into the base again. So, same old stuff that we've been seeing. So I passed on this one. I did not take the trade. And at the end of the day, I said, oh, thank goodness I didn't. Next day, it did what's called an inside day, didn't move, poked its head above and then couldn't come back in. So to be honest, I sort of lost interest in it, but I kept it on my watch list. The third day, this would be Thursday now, it opened here, ran all the way up, and then did exactly the same thing again, came right back. So by now I'm saying, okay, I'm done with this thing. I have no interest. Well, guess what? Friday, it gaps up, opened here, and then it's just ripped higher and closed right at the high. So up, 12.5% on the day. So I missed it, but then again, I didn't miss it. I'm sort of following my rules. This next one, though, I did absolutely miss. My note from last weekend was, let's wait for the breakout. So the breakout is here. So I should have had an alarm set at $31 or slightly under 31. And I didn't. I don't know why. And look what, and then it rips to 34. So there's a 10% gain just from my entry point. It would have happened on Friday had I been a little more attentive. So one thing to have a plan, but you really should follow it. Back to plan for the S&P. We could, as I said earlier, we could come back up here and test this declining 40-week moving average. So I would be inclined, if we get another close this week above the 10-week moving average, or coincidentally the 50-day moving average, if it closes this week above there, I would be inclined to put of my cash, I was sitting all in cash, I would put 25% into the S&P. And then the stop would be below here. That's, I think I did the math of that's about 7%. So if you risk 25% and lose, and it does stop you out, you lose 7%. The impact on your entire account is only about 1.5 or 1.6%. And then if we can get two closes, because this is still declining, we get a couple of closes above the 40-week moving average, I would add another 25% and get to 50% invested. And then I would hold off the balance until this moving average starts turning up, which could be 2 or 3 months from now. So that's sort of a plan. Looking beyond that, what I would worry about for next year is that we do, something like this for the entire year. And this is harmful to the account. Because you just get in and you got to get out, then you get in, you get out, and you get a whole bunch of little paper cut losses. And by the time you add it up at the end of the year, you're not fully invested. So at least part of your account's getting some interest on your cash. But might lose 2 or 3% on the ins and outs. So that would not be a happy scenario. I mean, I'd rather, believe it or not, it just did, oops, wrong one. It just did this, because then we'd be 100% cash, and at least nowadays you can get 3, 4, 5% on your cash. So at least we can get some kind of a return. But we'll see what happens. We're not in the business of predicting. We just react to what the market is doing. So, okay, that's it for that. If there's anything really interesting in my scanning this weekend, I'll pass it on. Because we're in this sort of chop area, there may be some sectors that are performing much better than others, so that might be of interest, because that's the only thing you can do when the market is, if it's going to end up going like this. You can't be in the index as a whole. You're not going to make any money. You're gonna, I mean, if you show the IWM small cap, we went through this as a weekly chart after the COVIDs, and then it just, after here, from February 2021 to out here, January 2023, or 2022, you really made nothing. It just went nowhere. So if we get into that kind of an environment again, having the major index doesn't do you any good to your account. But within this, there's sector rotation, so there could be opportunities to still make a lot of money if we can get into the right sectors, even in a choppy market. So it's either that or just stay in cash. Okay, that's it for this week, and have a good week, everybody.